What's up, everybody? If you're investing this year, you're probably frustrated. Even over the last couple of years, stock prices have just been all over the place. I talk about a lot of individual stocks here. I share my portfolio right here on YouTube, but what I want to talk about today is kind of the basics of how stock prices work. And I think you'll walk away with a better understanding of why stock prices move so much, why they've been so crazy lately, and what we should expect realistically moving forward. What we're looking at right here are AMD, NVDA, Taiwan Semiconductor, the S&P 500, and the NASDAQ QQQ, which is basically just a lot of the largest tech stocks. We're looking at them over the last year. And as I just talked about, AMD is down 46%, NVIDIA is down 55%, Taiwan Semiconductor is down 34%. The S&P 500 is down 17% and the NASDAQ is down 27%. This has been hard for investors. And seeing stock prices move this wildly kind of doesn't make that much sense if you think about it from the perspective of these are actual businesses, and you wouldn't think that the value of a business changes this drastically over such a short period of time. But the fact of the matter is there's two factors at play. There's a lot of factors at play, but two huge factors are short-term sentiment. That can be driven by momentum, fear, things unrelated to the actual business. That's how short-term stock prices are decided, essentially. Just what happens on a day-to-day basis. But over the long term, the thing that actually dictates stock prices, for the most part historically, is the actual performance of the business. Businesses earn revenue and they earn earnings. So essentially you have how much total money a business brings in, and then whether or not it's profitable, if it has earnings, or if it's at least on its way to profitability. Maybe it is unprofitable and has negative earnings, but they're improving every quarter and every year, and one day that business will be profitable. This is the story of almost any great stock that you can think of. Microsoft, Amazon, Apple, stocks like that. They were unprofitable early on, and for the most part, they are very profitable now. Amazon is kind of in between. So that's the first point, is having an understanding of the two different time frames that we're talking about. Short term, which is anything under a year, it's almost impossible to know what any stock is going to do no matter what anybody tells you. But over the long term, 1, 3, 5, and 10 years, businesses that grow revenue and grow earnings usually perform pretty well. And let me show you. So even though these stocks are down so bad over the year to date, let's look at over 3 years. And I mean, just over 3 years, AMD is up 148%, NVIDIA is up 194%, Taiwan Semiconductor is up 87%, the S&P 500 is up 35%, and the NASDAQ is up 53%. So just that little perspective change from year to date, horrible, terrible, you feel like you're the worst investor ever, to 3 years, you're pretty happy. So if you would have bought these things 3 years ago, fallen asleep, and woken up today, you'd be pretty happy with your returns if you didn't see what happened in between. Now let's zoom out even more. It's only going to get better. So 5 years, performance is even better. The winner here is AMD, up 511%. Over 10 years, this is where it gets crazy, and this is what I strive for as a long-term investor. I want to hold great companies for 10 plus years so I can hopefully achieve these kind of returns. AMD up 1,800%. NVIDIA 4,000%. Taiwan Semiconductor really struggling there, only up 556%. S&P 500 up 241%. NASDAQ 398%. What is that in dollar value? Well, we'll just talk about some, right? AMD, if you put $10,000 in 10 years ago, you've now turned that into $196,000. NVIDIA, $415,000. That's life-changing money. So lesson number one, we want to put time in our favor and let the businesses work for us. And that's, in my opinion, the best way to kind of predict stock prices going up, right? Okay, so we've talked about the basics. There's short term, which no one knows what the heck's gonna happen. And then there's long term, which you start to identify great businesses, and those stocks tend to do well over time. Okay, so now we're gonna compare AMD, NVIDIA, and TSM, Taiwan Semiconductor, on a number of metrics. We're gonna look at their price to sales multiple, their price to earnings multiple. We're gonna look at their sales growth, their earnings growth, and then their profitability metrics, and then how much capital expenditures, so that is how many factories do they have to run, how much do they have to pay to run their business and invest in things like factories, manufacturing, production. First is the market capitalization. This can be thought of as just the total size of the company. AMD is 123 billion, NVIDIA is 321 billion, and then Taiwan Semiconductor is 394 billion. You'll also see, in addition to market cap, you'll see enterprise value. Enterprise value is essentially just the market cap minus the debt. And so what you'll see here is that AMD is only, its enterprise value is only 3 billion less than its market cap. NVIDIA is about 5 billion less. But here we go, TSM is almost 20 billion less than its market cap. So what that says is that they have more debt on their balance sheet than AMD and NVIDIA. And the reason for that, and again, this will shine through in the evaluation of these different businesses, which is why I wanted to use these three. The reason for that is because it's really expensive for them to open up what's called foundries, and that's where they actually produce the chips, right? So these are all semiconductor companies, but AMD and NVIDIA can be thought more of as technology and software companies. Their advantages and the things they do are more proprietary, right? They develop software and essentially the layout of the chips that they want. And then TSM is actually the foundry. They have the factory where the chips are actually produced. And they actually produce chips for both NVIDIA, AMD, and pretty much the rest of the world too, which is why this is such a critical company. So anyways, right off the bat, without looking at any other metrics, I can already tell you that TSM has higher CapEx costs. And I understand a little bit more about the business. NVIDIA and AMD have less, and just knowing about these businesses, they have higher price sales multiples and higher price earnings multiples, okay? So let's work down the business here, and this is using Seeking Alpha. I have a premium subscription. If you're interested in this, there's a link down in the description below where you can sign up for premium for 99 bucks instead of $240. Okay, first thing here is dividends, right? AMD does not pay a dividend. NVIDIA really doesn't pay a dividend neither. It says 0.12%, but TSM pays a nice 2.3% dividend, okay? So if you're some type of income investor, not that that's a lot of income, but it does pay a 2.3% dividend. And the cool thing about it is that dividend is growing. Over the last 5 years, the CAGR, compound annual growth rate, has been 10%. So that dividend and the amount you get is going to grow over time as they keep increasing it, if they keep increasing it. Okay, and this is what I was talking about, price to earnings ratios. So looking forward 1 year, this looks at what earnings are expected to be over the next year. Then we have a 2 years, and then over the next 3 years, right? So we see AMD has forward 1 year, it's a PE of 17, NVIDIA is at 38, and TSM is at 12. So we're already seeing it, right? TSM's PE ratio is like 40 or 50%, maybe even more. I'm doing it off the top of my head, 60% lower than NVIDIA. And then, 20 or so percent lower than AMD. And then if you go 3 years out, so this is what I was talking about, the growth, right? Well, TSM is only dropping from 12.5 to 10 over the next, 3 years. So that's a drop of, 20, 25%. So still decent. So that means that earnings are growing, which is going to bring this price to earnings multiple down to 10, right? But earnings are expected to grow faster for NVIDIA and AMD because the price to earnings ratio is dropping based off earnings expectations more than TSM's is, right? And so 3 years out, you've got AMD at 13 and NVIDIA at 24. So what this tells us is that all these businesses are expected to grow. There's probably more risk associated with these two companies because if they don't meet their growth expectations, they're going to get hurt and they might trade at a PE ratio closer to something like TSM. And if that's the case, you have less margin of safety by buying AMD and NVIDIA than a company like TSM. That doesn't mean TSM is the better buy. It means that it has likely a higher margin of safety, but you might have more upside in AMD and NVIDIA. We're going to get to that in just a second. I'm going to end this video by telling you which one of these three I actually think would be the best investment right now. I don't own any of them right now. Okay, so that's price to earnings, right? Let's jump down to enterprise value to sales, or basically price to sales. So if we look enterprise value to sales forward, AMD 4.6, NVIDIA 11.6, and TSM 5.3. And if we look at trailing 12 months, TSM's at right around 6, NVIDIA's at almost 11, and AMD is at 5.6. And so from a price sales basis, AMD and TSM actually trade about the same, right? And then NVIDIA is almost double. Okay, so NVIDIA is looking pretty, risky right here compared to AMD and TSM. And this is where returns are basically made or blown up, right? If you pay too much for a stock that doesn't have the growth to back it up and isn't gonna grow enough to back it up and make that stock worth as much as you paid over time or more, then you can get hurt. But sometimes if you find a company that is trading at a discount and it is a strong grower and going to continue to grow, that's where you can have really amazing returns, right? And so if we look at revenue growth year over year, AMD's at 61%, NVIDIA's at 35%, and TSM is at 29%. And so right here, you can start to see a little bit of why TSM is maybe trading at a lower multiple than these other two. They're expected to grow. They are growing faster. So then if we look forward, revenue growth forward, TSM 18%, NVIDIA 23%, AMD 45%. And remember, AMD and NVIDIA, it's actually, AMD is trading at a lower price sales multiple than NVIDIA, but it's expected to grow faster. So just again, by looking at these numbers, AMD looks like the better buy right now. Okay, sometimes revenue growth can get thrown off by like a really hard comp or an easy comp. And so maybe 61% revenue growth isn't that impressive if the quarter they're compared to last year was, a really bad quarter. So what we can do is we can look over the last 5 years, how much have they grown their revenue? And that tells us, which one has been performing strong and which one is expected to continue performing strong. And so over the last 5 years, AMD's at 35% revenue growth, CAGR, compound annual growth rate, NVIDIA's at 30%, and TSM is about 14%, so about half that. And so again, if you look at it, okay, TSM is valued at a lower price sales multiple, but revenue growth has been slower and it's expected to stay slower. Profitability is the other big factor, right? If a company is more profitable, people will pay more for it for slower revenue growth. That means the business is just worth more money. You can earn more money and more profits off of less revenue if you are a more profitable company. So how is that decided? Gross profit margin. So we have AMD at 50%, NVIDIA at 60%, and TSM at 55%. Okay, another big factor, net income margin. What is essentially the income that's hitting the bottom line? For AMD, 14.5%. Okay, they're investing for growth, so net income is a little bit, lower than these other ones. NVIDIA, 26%. And then TSM is at almost 41%. Okay, so this is starting to make sense. TSM is growing revenue slower. Their gross margin is pretty much right in the middle, but their net income is significantly higher. So they're not investing as heavily for growth, and they're a more, at this point, sustainable and profitable business than AMD and NVIDIA. The theory and the strategy for these two companies is that they're investing very heavily for growth, and eventually this number would come up because they're not going to have to invest as heavily for growth in the future. But the goal is to get their revenue so high that even at a lower net income than, say, TSM, they're still bringing in more total profits because of all of the investment they made and the market they're in and all of that stuff. It sounds complicated, but that's how people are judging these stocks and which one should be valued at this multiple and that multiple. Okay, and so here we go. Total cash on the balance sheet. This makes a business, be able to sustain through downturns, right? I don't think any of these businesses are really at risk of going bankrupt, but here we go. Total cash, AMD about $6 billion, NVIDIA about $17 billion, and TSM about $49 billion. Total debt, $3.2 billion for AMD, $11 billion for NVIDIA, and $30 billion for TSM. So net debt, which is debt minus cash, you get negative $2.79 billion for AMD. So again, the lower the number here, the better theoretically. You get minus $5.2 billion for NVIDIA and minus $18 billion for TSM. And then you want to see, debt to equity. You've got 5.8% for AMD, 49% for NVIDIA, and 36% for TSM. So the lower the percentage here, the better. But again, none of these companies are really at risk of bankruptcy in my opinion. And so finally, we get down to the cash flow statement, right? And so we could see the cash flow, and this is all great, but what I want to show is the capital expenditures. This is what I talked about. TSM, because they're a foundry, because they actually produce the chips, they have a lot more capital expenditures, $30 billion. NVIDIA has $1.29 billion, and AMD has $374 billion. Again, this is why these stocks have higher multiples. This number for TSM is not going away. They have got to pay that much money every year to keep running their business because those are real world factories and costs associated with keeping the business running. AMD and NVIDIA, they don't have as many factories and hard goods essentially, or hard costs, expenses that they have to pay for. You can see that their capital expenditures are so much lower. Where a lot of their costs are and why they're less profitable is because they're investing more in research and development, more in sales and marketing, and then a lot more in stock-based compensation. So theoretically, at one point, again, I've said this multiple times, AMD and NVIDIA, if they stop investing so much in research and development, stop investing so much in R&D, stop giving so much stock-based compensation, these businesses theoretically could become close to as profitable or more profitable than TSM. But if they stop those things, then their growth is likely going to slow down. So it's a constant battle, right? So we talked about some of the similarities and differences between these stocks and kind of how stock prices can be very volatile over the short term, but over the long term, the performance of the business is what really dictates the stock price. Right now, I want to make a little model. We're going to go 5 years out, and we're going to try to see what are good low, medium, and high prices to pay for these stocks right now based on how their businesses have performed in the past and how we think they might perform in the future. These are just guesses, and they're going to be wrong, but they give us a frame of reference. So what we need is what our expected revenue growth per year is over the next 5 years, expected profit margin, expected free cash flow margin, a PE multiple, and a price to free cash flow multiple. And so if we look at this, we are looking at NVIDIA right now. This is their revenue growth expectations for 2023 through 2027. They're looking at 4%, 13%, 18, 13, 15, and 15. So I'm going to probably use about 11% up to 18% or so for the analysis. Okay, so what I've done is I've built out a little scenario here, a low, a medium, and a high scenario based off kind of what their revenue growth history has been, but also what analysts are expecting, and then what their profit margin has historically been, free cash flow, and we've made some adjustments for PE as the growth slows down. So low scenario, we've got 11% revenue growth, 24% profit margin, 21% free cash flow margin, and 18 PE. If they're growing at 11% earnings, 18 actually might be a little bit high for that, but hey, we'll stick with it. Price free cash flow of 20, desired annual return of 10%. Then we jumped up, a little bit for each one. The middle scenario is 15% revenue growth, and the high scenario is 18% revenue growth. And again, remember, this is on average over the next 5 years. Let's hit analyze and see what comes out. Okay, so right now, according to this scenario, if you think that these are somewhat accurate, NVIDIA would not be a buy until, if you think the high scenario is likely or accurate, it would be a high at 123, which is down about 10% from here. Middle scenario, 94, and low of 68. So what I'll do is I'll put this on my watch list here on Everything Money, hit notify me, and then it'll notify me if it gets down to around that mid-range where I'm really interested in buying it. It may never get there, but that's okay. Okay, jumping over to AMD. So we have earnings expected growth through 2022 to 2026, 66% in 22, but then 12%, 21, 15, and 16. Okay, got it. And then revenue growth, and these are analyst expectations. Again, it shows you how many analysts over here are covering it, 42, 41, 17, 14, and 14. That's how many have their estimates in. And again, revenue growth, we got about 13%, 12%, 11%, and 13%. Okay, so based off kind of, again, AMD's history here, I've done 11% revenue growth for low, 14% for mid, high is 18, profit margin 13, 15, and 17. Again, over the last 10 years, they were at 7%, but now the business is, becoming more profitable, so they're right around 14%. So I think that's a good range. Free cash flow is right about the same as profit margin, so just keeping that the same. PE has been 39 over the last year. But I've got it at low of 18, 20, and 22. Remember, and we're going to go actually 5 years out, not 10 years out. So we're doing 5-year analysis here. And then price to free cash flow of 37. So got it going down to 18, 20, and 22. And our desired annual return is about 10% because we can get 10% from just owning index funds on average over time. So I want to do better than that. Let's hit analyze and see what comes out. Okay, so AMD is looking like it is a little bit of a better buy right now. If you believe these scenarios to be true, than NVIDIA. So again, I'm gonna go to the mid price. And so right now it's at 76. I'm gonna go to the mid price of 58, hit that to notify me below. I'm gonna stay on this page and that way I'll get a notification if it goes below 58. You might disagree with me and let me know down in the comments if you do. Definitely open to feedback. Maybe I'm being too conservative on these companies. Taiwan Semiconductor. Analyst estimates. Here we go. Earnings, EPS growth, 3%, 17, 8, and 10. So, a little bit lower than what's expected for NVIDIA and AMD. But then revenue growth is actually kind of in the same ballpark, right? So we're not looking at 2022, but we're looking at 2023, 10%, 18%, 12%, and 14%. All right, let's jump over to estimator. Or analyzer. Okay, and so remember, a little bit slower revenue growth, right? So I've got 10, 12, and 14. Their profit margin, much higher though, and that's gonna probably stay the same. So I've got 35, 37, and 40. Free cash flow margin has been lower. Again, that's because of that CapEx, 20, 23, and 26. PE is at 16 right now, and I've got it going down to 13, 16, and 19, which if you remember, that is actually lower than 18, 20, and 22 that I used for the other two, okay? So this one's, I expect to trade at a discount. Price free cash flow, 20, 22, and 24. Annual return, we want that 10% still. Okay, and here we go. Let's hit analyze and see what happens. And so here you go. So current price is 77. High scenario, if you think is most likely, 131. Mid scenario of earnings multiples at 97, and then a low scenario is at 72. So actually this one right now, TSM, looks to be the best buy of these three right now based on just this estimate, which again is gonna be wrong. Here's your prices. I'm gonna set this actually. So I wanna know if it goes below 72, then it's like really a buy. But I also want to know if it goes above 131, because then it's kind of like out of the range, right? And I would need to reassess it. But we're almost 100%, it'd be almost a 100% return. So right now, TSM, in my opinion, is showing as the better buy.